Okay, it is February 3rd, 2026.
Yeah.
And today we're going to talk about a company that is, it's quite literally the backbone of the caloric economy.
That is a very specific way to
Yeah.
put it,
Right.
and a very accurate one. We were talking about Archer Daniels Midland, ADM.
Now, if you're listening to this and you're thinking, okay, a grain company, how exciting can this possibly be? Just stick with us.
Please do.
Because ADM, it's not just about, moving corn from Io to a port.
Mm-hmm.
They're this massive barometer for the global economy.
Yeah.
They sit at the exact intersection of what you eat, what you drive, and how the global supply chain is actually truly functioning.
They really do. I mean, they touch everything. If you drank a soda today, if you ate a burger, filled up your car with gas, you probably interacted with an ADM product.
They're the ultimate middleman of the world.
They are.
And so the mission for this deep dive is pretty clear.
Mm-hmm.
ADM just dropped their Q4 and full year 2025 earnings report this morning.
Mm-hmm.
We've got the transcript, the press release, the slide deck right here.
Yeah.
We're going to unpack the numbers, obviously.
Mm-hmm.
But we're also going to look at how this weird mix of government policy, changing human diets, and yes, we are going to talk about the weight loss drugs, and global trade shifts are all reshaping this agricultural titan.
It's a fascinating report. It really is.
Yeah.
Because it highlights a company in just a massive state of transition.
So let's not waste any more time. Let's start right at the top with the headline numbers. Because if you just looked at the bottom line this morning, you might have thought, wow, pretty solid quarter.
Right. The headline number was the adjusted earnings per share, or EPS. It came in at 87 cents.
And the consensus on Wall Street was, what, 84 cents?
84 cents, exactly.
Yep.
So technically that's a beat. They squeezed out more profit per share than the market expected.
Which usually signals that a company is just firing on all cylinders.
Yeah.
But then you look at the top line.
Yeah. The revenue.
And the story gets a little bit murkier.
Murkier is a polite way to put it. Revenue came in at $18.56 billion. The expectation was over $21 billion.
Whoa. That's a miss of what, $2.5 billion?
It is a huge gap. And year over year, that's a drop of 13.7% compared to this time last year.
So they're profitable, maybe through cost controls. But the actual amount of stuff they sold just contracted significantly.
That's the story.
Okay, before we get into why they sold less stuff, we have to address the elephant in the room. Or maybe the dark cloud that's been hanging over their Chicago headquarters for the last year or so.
You mean the investigations?
Exactly. For a while now, ADM has been dealing with government investigations from the SEC, the DOJ, into their intersegment sales reporting.
Right. Basically how they account for money moving between their own internal divisions. It's the kind of thing that makes investors really, really lose sleep.
It just creates so much uncertainty.
It makes a stock uninvestable for a lot of people. But today, we got some pretty definitive news on that front.
We did. The CEO, Juan Luciano, he started the call by being very, very clear. The investigations are officially closed.
He said they are, quote, pleased to put these matters
Behind the company.
Yep. That has to be just a massive relief for that whole leadership team.
Huge. It removes that layer of legal risk. It means management can stop spending their days in meetings with lawyers and get back to focusing entirely on operations.
As we dig into the segment data, it's pretty clear they need to be focusing on operations because the market environment right now is tricky.
Tricky is the right word. So let's look at the core of the business. Ag services and oil seeds. AS&O. This is usually the heavy lifter for ADM, right?
It is. This is the segment that moves the grain and crushes the beans.
So how did the core hold up?
It struggled. Operating profit was $444 million. Now, that sounds great, nearly $500 million, but it's actually down 31% from last year.
Ouch. A 31% drop in your biggest segment? That is steep. What's
Right.
driving that? Is the world just eating less soy?
It's a bit more complex. So first, exports from North America, they slowed down. We're seeing a shift in global trade, and the U.S. export engine was kind of sputtering a bit in Q4. But the bigger factor here, and this is a term we need to unpack, is crush margins.
Right. Let's do that, because this comes up every single time with ADM.
So think of it as their fundamental equation. ADM buys a raw soybean from a farmer. That's their input cost. They take that bean to a plant and they crush it. That makes two things. Soybean meal for animal feed.
Like for chickens and pigs.
Exactly. And soybean oil, which is used for cooking or, increasingly, for renewable diesel fuel.
So the margin is just the difference between the value of the parts and the cost of the whole bean.
That's it. It's the value of the meal plus the oil minus what they paid for the bean. And if beans are expensive but oil and meal prices are low, your margin gets, well, crushed, pun intended.
And those margins were weak in Q4.
They were significantly weaker, both in North and South America, but there's also this psychological piece to it that involves the farmers themselves.
The farmers, how so?
Well, crop prices have been muted, they haven't been great, and farmers these days have a lot of storage capacity. So in Q4, we saw a lot of farmers basically just go on strike.
They weren't selling.
They weren't selling, they locked up their bins and decided to wait for better prices.
So ADM is sitting there with these massive plants ready to go, but the farmers are holding tight.
Right. And on the other end, their customers, the food companies, they were holding less inventory because they didn't want to get stuck with high costs. So ADM got squeezed from both ends.
That sounds like a tough spot. But I noticed something in the transcript, and you flagged this about insurance. Is that 31% drop actually a fair comparison?
This is a really important detail. To understand the true health of the business, you have to see the accounting noise.
Okay.
The numbers look worse than they are because last year, in Q4 2024, ADM got a big insurance payout related to incidents at their Decatur plant.
Right, I remember that. They had a big facility issue.
Exactly. So last year's profit was artificially inflated by that one-time insurance check. This year, they didn't have that extra cash coming in. So while the business is under pressure, that 31% drop looks more dramatic than the operational reality.
That is crucial context. It's not just that the business collapsed, it's that they didn't get a bonus check this year. Okay, let's move on. Next segment. Carbohydrate solutions.
This is the corn business.
Right. Sweeteners, starches, ethanol, and this. This is where the report gets really, really interesting. It felt like a tale of two different worlds inside one segment.
It absolutely was. Total profit for the segment was down slightly, about 6%, but the dynamics inside were just wild. You had one part of the business shrinking and another part just booming.
Let's start with the shrinking part. Starches and sweeteners. The stuff that goes into soda, candy, packaged foods. It was down 16%. My first thought was just, okay, inflation.
That's the natural assumption, right? But the CEO, Juan Luciano, he pointed to something much more specific, more structural. He didn't just blame the economy. He talked about actual consumer behavior changes.
And this brings us to the topic everyone is talking about, GLP-1s, the weight loss drugs.
Exactly. We've been speculating for years, will Ozempic hurt junk food sales? And here we have the CEO of one of the world's biggest food ingredient companies basically saying, yes, it is.
What did the data show? What did he actually say?
He noted that when families adopt these drugs, consumption drops initially. People just eat less food. But more importantly, the mix of what they buy shifts.
Oh, so?
They buy less of the savory and sweet snacks, and they move toward more protein.
So fewer Cokes, fewer candy bars, less high fructose corn syrup and everything.
Correct. And that is directly hurting their liquid sweetener volumes. They said they're down about 5 to 7%.
That is a significant hit. In the food world, volume usually stays pretty flat. A 5 to 7% drop, that suggests a real fundamental shift in demand.
It feels huge. If that trend accelerates, that is a long-term headwind for their entire syrup business. It's not a bad quarter, it's a changing customer. It forces them to rethink that whole business line. But, and here's the tale of two cities part, while sweeteners were down, something else in the corn business was absolutely skyrocketing.
Ethanol.
Specifically, their Vantage Corn Processors unit. Operating profit there was up 187%.
Whoa, up 187,
Yeah.
nearly triple.
It was a blowout quarter for ethanol.
Okay, why the disconnect? It's all corn, right?
Yeah.
Why is ethanol booming if sweeteners are struggling?
It comes down to exports and competitiveness. The U.S. is just incredibly competitive globally in ethanol production, even compared to Brazil, which is the other powerhouse. Exports were strong, industry margins were stable, and ADM just capitalized on it.
So people are drinking less soda, but the world is burning more U.S. ethanol.
Precisely. And it really shows the benefit of their diversification. If they were just a sugar and syrup company, this quarter would have been a complete disaster.
But because they have that energy leg of the stool, they could offset some of the weakness in food. Let's talk about that third leg, nutrition. Historically, this has been the trouble spot for ADM. They spent billions building this up, buying flavor companies, probiotic companies, but it's had some headaches. Is it finally turning a corner?
It seems to be in recovery mode. Operating profit was $78 million, which is down 11% year over year.
Still down.
Yes, but again, we have to look at the insurance factor. Same story. They had insurance proceeds in the segment last year, too. If you strip that out, the underlying business is actually improving. And the big news here is operational.
What's that?
The Decatur East plant is finally back online.
That plant has been a thorn in their side for a long time.
It was down or unstable for 18 months. I mean, that's a lifetime in manufacturing.
Yeah.
Getting that facility stabilized and running is a massive win for their self-help strategy. They can finally start fulfilling orders reliably.
And speaking of nutrition, I want to geek out for a second on the science here. Because sometimes you think of ADM as just guys with shovels moving grain around.
Right.
But on this call, they talked about some really high-tech biology.
They did. This is the science part of the business. The CEO highlighted what he called a breakthrough natural blue pigment.
Okay, why does a blue color matter?
It's actually a huge problem in the food industry. Blue is exceptionally rare in nature. Think about it. You have red from strawberries, orange from carrots. Where do you find a stable blue?
Blueberries.
Even with blueberries, when you crush them up, the juice is more purple or reddish. Finding a stable, water-soluble, natural blue to replace artificial dyes like blue number 1 is like the holy grail.
Because consumers don't want artificial colors anymore.
Exactly. And ADM claims they have cracked the code on a natural blue that actually works. That's a super high-value ingredient.
So they're basically mining nature for the rarest colors. That's pretty cool. They also mentioned clean citrus and an allergen-free pea protein.
Right. And that pea protein, it connects right back to that GLP-1 trend we were just talking about. If people are eating less sugar and more protein, well, ADM wants to be the one selling them the protein too. They're targeting the specialized nutrition market protein shakes, bars, which is exactly where consumer dollars are moving.
That's a smart pivot. Okay, so that's the look back at 2025. A mixed bag, but stabilizing. Let's look forward. They gave guidance for 2026, and honestly, the range feels huge.
It is unusually wide. They forecasted adjusted EPS of $3.60 to $4.25.
That's a 65-cent spread. For a blue-chip company like ADM, that implies a massive amount of uncertainty. Why don't they have a better handle on what they're going to make?
In a word, Washington.
Oh. This brings us to the policy piece.
The entire forecast seems to hinge on the U.S. government's Renewable Volume Obligations, or RVO.
Okay, let's break that down for anyone who isn't a policy wonk. What is RVO?
It's basically the government mandate that says, hey, oil refiners, you must blend this many billion gallons of renewable fuel into the nation's gas supply. It's not a suggestion. It's a law.
And how does that affect ADM?
ADM makes the vegetable oil and the ethanol that goes into that renewable fuel. So if the government sets a high mandate, demand for ADM's soy oil for renewable diesel just skyrockets. Margins go up. They hit the 425 end of their guidance.
If the government delays the decision or sets a low number.
Then demand softens, margins stay flat, and they're looking at the low end around 360. They were very open about this on the call. They basically said, we can control our costs, but we cannot control the EPA.
That is a tough spot to be in when your profitability is decided by a regulator's pen.
It is. And it's not just the RVO. There was also mention of a tax credit, the 45Z.
What's that one?
That's the clean fuel production credit. ADM thinks this could be a $100 million benefit to their bottom line. But again, the rules are still being finalized by the Treasury. So you have $100 million just sitting in legislative limbo.
That has to be frustrating.
Yeah.
But they aren't just sitting on their hands waiting for a call from the White House, right?
Yeah.
They talked about self-help.
Correct. They can't control the government, so they're controlling what they can, their own spending. They're aggressively cutting costs. They're targeting $500 to $750 million in savings over the next 3 to 5 years.
That is a big number.
It is. This isn't just tightening the belt. This is structural efficiency. They're trying to make the machine leaner so that even if the policy environment is bad, they can still make money.
And despite all the uncertainty, despite the investigations and the weird market, they did something for shareholders that really speaks volumes.
They raised the dividend again.
That's quite a streak they've got going.
53 consecutive years of dividend growth. That puts them in the absolute elite tier of dividend kings. It's a powerful signal to the market. It says, look, even when things are messy, we generate cash and we pay our shareholders.
So let's try to pull all this together. We've covered a lot. Earnings beats, revenue misses, weight loss drugs, blue pigment, government mandates. What's the big picture here?
I think the big picture is stabilization. 2025 was an incredibly rough year for ADM. You had investigations, plant shutdowns, these shockwaves from consumer diet changes, but the investigation is closed, the plants are running, they're adapting to the diet changes with things like that pea protein.
But they are still fighting through a pretty weak cycle in soy crushing.
They are. The ag cycle is working against them on crop margins right now, but they're sitting on this potential gold mine if those biofuel policies break their way.
It really feels like they're positioning themselves to be ready for the upturn, whenever that finally comes.
Exactly. They're cleaning house, getting efficient, and waiting for the signal from Washington.
So here's where it gets really interesting for you, the listener. We usually think of a food company like ADM as being at the mercy of Mother Nature,
Yeah.
right? We watch the weather. Is it raining in Iowa? Is there a drought in Brazil?
And that's still true to an extent. The weather always wins in the end.
But look at what we just discussed. The biggest drivers for ADM's success in 2026, they aren't really coming from the sky. They're coming from the legislative pen in Washington, that biofuel policy, and from the medicine cabinet in American homes with those GLP-1 shots.
That is a profound shift.
So it raises this provocative question. Is the future of agriculture actually just the future of regulation in pharma? Are we moving from a world driven by harvest cycles to a world driven by policy mandates and prescription trends?
It's certainly looking that way. The farm is becoming a downstream supplier to the energy sector and to the pharmaceutical reality of the consumer. It's a very different game than just selling corn.
A different game indeed, and one we will definitely keep watching. That's it for this deep dive into ADM. Thanks for listening. We'll catch you on the next one.